Stanlib's Balanced Fund targets investors looking at a real return exceeding inflation by 2 to 4%. Therefore, the fund is positioned to provide an 8 to 10% return over the next year by applying various correlations of assets. The fund invests in a diversified spread of cash, bonds, property, equity and offshore assets with a maximum of 75% in equities, pretty much what we've seen from Coronation's Balanced Fund just a moment ago. For more, I'm joined by Paul Swanson. He's a fund manager at Stanlib, and of course, just in terms of performance, we've seen from this fund, Stanlib's fund, top quartile over 1 and 3 years. So you guys know what you're doing.
Yes.
I did pitch you, though, unfairly against Charles de Kock because I knew that his stance on Sasol differed from yours. As Charles points out, the market is made up of divergent views.
That's right.
You heard him there say he was very excited about the projects in the shale gas space, and your criticism, of course, of Sasol is that you don't see any new exciting developments come on stream.
That's correct, Bronwyn. We've actually sold out of all of our Sasol around October last year. So we've got a 0% weighting in the portfolio. And our concerns are the earnings. We think that there are no earnings of any sort of magnitude coming through. It's going to be a very sort of stodgy earnings period for Sasol. And also on top of that, no big projects. The next big project we see coming on stream is 2018 in Uzbekistan. So we're just not seeing any excitement in the business. We would rather be going into a BHP Billiton or an Anglo-American. And that's how we are actually positioned in terms of our commodity exposure in the portfolio at the moment.
Vaughan Henkel, I know you're going to go with a question here, but Vaughan Henkel is also in your space from RMB Morgan Stanley. They also have been underweight Sasol from the beginning of this year. It's worked in their favor. They also, just for interest, underweight oil and gas and energy.
I mean, the question I want to throw on the table now is that if you actually look at that whole CRB index recently, and you look at the broader industrial commodities, you look at energy, you've seen that come off and on a technical basis looking really, really soft. Yet, I mean, you're still preferring quite a decent exposure, I believe, to your Anglos, your Billitons, your diversified miners. Your view on that, maybe over a shorter time period, and then also why you think it actually represents value over a longer time period.
Yeah, I think the point at the moment is if you look at Anglo-American, there's a lot happening within the company at the moment. Got a really sort of reinvigorated management team who are looking to unlock value. So there's a lot happening in terms of restructuring of the businesses. The mix of resources is looking very, very appealing to us. And I suppose the question for Anglo-American now is what they do with Amplats. Are they going to restructure that? Are they going to unbundle it? There's a lot on the go then. We think there's a lot of corporate value unlock which could happen in Anglos. Billiton, on the other hand, just a great business with great products. You know, they've really got all the right commodities at the right prices, and they really are running hard and fast with a lot of cash on the balance sheet. So we really like it at the moment. So we're not big bulls on resources per se. We just are very focused on the diversified commodity players. That's where we're seeing value at the moment versus the single players.
And your offshore equity allocation sitting at around about 20%. So you're pretty near full allocation on that front.
Yeah, exactly right. And if you also take into consideration, we've got about 4% in British American tobacco at the moment, which is a pure rand hedge stock in the portfolio. So we're right up around 25%. Got some Richmond in the portfolio as well, a little bit of SA breweries, so all looking pretty good.
I see that smile coming.
Yeah.
Everybody talks about Richmond after their recent rally of 7.5%, smiling broadly. In terms of your healthcare exposure, you've got a significant exposure on that front, haven't you? The rationale behind it?
Bronwyn, I think what we like is the theme, the fact that everyone's getting older, everyone needs more medical equipment and more medical care. So we've got 2 hospitals in the portfolio at the moment, Netcare. We really like Netcare as a turnaround situation. We think there's a lot of value in the UK operations, but it's going to take time to come through. And then the other one we've got is Life Healthcare, 3rd largest healthcare operator in South Africa, paying out superb dividends and really growing the quantity of beds which they can license in South Africa. So those are the 2 healthcares we've got. We've also got Aspen on the pharmaceutical side. Aspen is really becoming a global player in terms of generic drugs, picking up a lot of the old sort of global GlaxoSmithKline factories and operations around the world and doing exceptionally well out of it. So healthcare is very big in the portfolio and we're very comfortable with it.
I mean, it's something that almost, leveraging off that. That's very much a defensive sectoral play that you've got in place there. Something in terms of looking at the fund as well is that you've got an exposure to your consumers. And again, it's been something where that sector's run particularly hard. But your view on that going forward, let's say over the next 12 months or so, and how's that going to affect your sectoral allocation in terms of your retailers and your consumer-led stocks?
We're still very comfortable with the consumer as a theme within the portfolio.
It is a big theme in your portfolio.
It's a massive theme. I mean, we've got mobile phones, Vodacom, MTN, which is consumer stocks. We've got lots of Woolies in the portfolio. We've got ShopRite in the portfolio. So we think the consumer is still going to do very well over the next 2 to 3 years. Why is it going to do well? A lot of the consumers are civil servants. They are going to get decent salary increases this year. That money is going to flow back into buying food. It's going to flow back into buying furniture. And we certainly just think it's a great theme, and that's the place where you want to be in South Africa. We're a country of retailers and consumers. We're not manufacturers.
And you aren't concerned, obviously you've got to put the proverbial question to you, because the debate is raging about these retailers, that they keep pushing higher and higher. The argument is, of course, that foreigners are buying into our retailers and have now pushed them through any valuation model that we potentially have. Can they continue? Is that the reason that they're going higher and higher, firstly?
Well, the foreigners are big buyers. They keep comparing our retailers to other emerging markets like Russia, and we look very, very cheap. I think the other thing which we like about the retailers is that the pricing, the volumes are there, the inflation is there, the margins are there, cash flows are there, and we've got very good management teams. I think our management teams are highly rated and highly regarded and are doing exceptionally well in this environment. So we think that's also helping.
So you're standing by this retail story?
We're standing by the retailers. We're very comfortable with our retailing position. There's no need in our mind to be selling retailers at the moment.
I mean, it's certainly a hold in your books, but I mean, would you be buying it at these levels? I mean, those valuations have been looking stretched for quite some time, but again, they continue to run. Would you be adding to that exposure?
I think we would be.
In dips?
In dips. If we see current price weakness as we are seeing in the market at the moment, we certainly would be lookers at buying some more ShopRite. We'd look at buying some more Woolies. We're very, very comfortable with those names and we're happy to hold them.
In terms of your preferred banking plays, I see Standard Bank doesn't feature. Let's move on swiftly from there and talk about FirstRand and Nedbank. Those are your preferred plays in the financial arena when it comes to the big banks.
Yeah, I mean, that's correct. I think the first point to make is that we don't like financials as a sector. So we underweight the sector at the moment, with our preference being for FirstRand and Nedbank in the portfolio. So why do we like FirstRand? We like the retail part of the business. Really, F&B is doing very, very well. The management coming through very strongly on that side. And then RMB on the investment banking side also doing exceptionally well. A big competitor and bringing a lot of sort of profit through to the table. So we're very comfortable holding F&B or FirstRand. There's been a lot of questions about valuations and pricing on that side. We still think it looks very good value and we're very happy to hold it. It's meeting all the metrics we want.
And the rationale for Nedbank, close your ears here. What?
Nedbank have done phenomenally well. I mean, under the new management team, which has been in place for about 18 months, they've got down, they've fixed the retail book. They're getting the home loans to come through. They're getting the unsecured lending to come through. And then on the capital market side, I think that's also doing very well. So I think Nedbank is a turnaround story, and it certainly is meeting the requirements.
Is there anything in there around potential corporate action on Nedbank?
Look, I think there's always going to be the concern that there's going to be corporate activity with Nedbank. Old Mutual have been quite clear in their minds that they don't want to own a bank. The question is, with all the global volatility, when are we going to find somebody who's prepared to buy Nedbank? I think that's the big debate or big question mark. But certainly I think it is on the table, and when we least expect it, it'll probably reappear back on the table with some corporate activity.
And even if nobody wants to buy you, you still a preferred play by Stanlib. So you're right up there in terms of a preferred investment play. Just very quickly, microfinance. Well, not quickly, we've got time. On the microfinance side, Able is your entry point on that front.
That's right, yeah. Look, Able, good set of results coming out of Able. We're seeing management tomorrow. They're coming into our offices. But I think what we're very happy about is strong growth in earnings, strong growth in return on equity. The unsecured lending seems to be going exceptionally well for them. And it's amazing how this business has transformed itself over the last 10 years into a financial institution which is very viable in a very, very competitive and difficult market. And we're very impressed with it and very happy with it. Very comfortable with the management team as well.
I think just to maybe digress a bit and take this up a level to a kind of a more macro question here, my big gripe with a lot of these balanced funds and the funds that play in this space is that you have this very large exposure to equities, and in kind of trigger events like we're seeing potentially Europe, that leaves your portfolio particularly vulnerable. Now, considering that you have a mandate of CPI plus a particular return, why the skew towards equities and not towards something like an inflation-linked bond?
Well, I think if you look at the portfolio, the first thing you've got to remember is that if you want to get real returns, you've got to go for equities. That's conceptually where you have to be. But at certain times within the cycle, you are going to have less equities in your portfolio. So as an example, we've cut our equity exposure from about 73% down to about 66% across the portfolio over the last 18 months. So we've only got around 46% of the portfolio in South African equities, with another 20% in global equities, which is our preferred asset class at the moment. Got lots of bonds in the portfolio. We've got government bonds. We do have corporate paper in the portfolio, and we've also got inflation linkers as well. So a combination of the various asset classes where we see value.
And at what point would you skew that disproportionately towards bonds, or so at what point would you manage that equity allocation aggressively downward to an underweight position?
We've done quite a lot of that in the portfolio. We've taken our bond position over the last 2 years from about 4% of the portfolio all the way up to 20%. And I think, if times get tougher or things get worse, we could quite happily move that up another 5%. There's a lot of value in the bond market at the moment. Interest rates are flat, they're not going anywhere, and you're getting a running yield of around 8%, which is a lot better than cash at the moment. And it's something we are monitoring quite closely.